You have entered into the black hole of real estate, a place for industry news, tips, and strategies. Once you enter into our vortex, even if you could leave, you're probably going to want to stick around. I'm your host, Ron Weiss-Sikarski, and you are now entering the black hole of real estate.
Well, I can't tell you how excited I am to be back. This is episode number 50 for the Black Hole of Real Estate, a milestone certainly for us, and exciting because a year ago this was just an idea, and it was hatched at Podfest Expo in Orlando. Chris Comitzo's a good friend of mine. Um, has this amazing VidFest and Podfest that I went to, and my commitment was to start a podcast, by the end of March. And during that time, we were doing the awkward elbow handshake because really the first week that people were hearing about this pandemic is when we were in the hotel and we're having this conference. And so it was a little bit different. We weren't sure what to make of it, but I did know there was a lot of amazing people in the room, and I learned so much that day about podcasting and VidFest and YouTube. And I thought, geez, there's enough people in the room that could really help me get this thing launched off the ground. And I made a commitment, and of course, I know that when you're going to do something and you're going to make a strong commitment, you tell everybody what it is you're going to do and when it's going to be accomplished for accountability. Ultimately, what happened was I told the world that I was going to launch a podcast, by March 31st, and wasn't promising it would be awesome or great. I promised I would launch one by then. I felt there was enough people in there that knew how to use the equipment and the microphones and how to mix this and do that and get it launched and put it on all the right places. I'd be able to accomplish that, relatively easy. What I didn't know was during that time, all the people I was connecting with were backtracking on perhaps offering those services because of the uncertainty of the pandemic or the logistics behind it. I quickly found out that if I was going to launch this podcast, it was going to be self-produced and self-launched. Interestingly enough, as we got closer to the deadline, I finally found a way to record it, found a way to upload it. And of course, we had to make some submissions to make those things work too, to actually get it out there on the web, for all podcasters to find. And then, of course, go to the different places in the Apples of the world where you can actually hear the podcast. And we were fortunate enough to get that first one launched, and we've been doing it ever since, bringing real estate industry news that's timely, that's insightful, that provides information to all of our listeners. And I couldn't be more pleased to be on episode 50 today. I was told that after about 50 episodes, you'd start to find your groove a little bit, and that would be an important thing, and to get that done, within about the first year, which we've pretty much done. So, mission accomplished. Did we skip a week here or there for holidays or things? Absolutely. Life does happen. And I don't know that anybody was like, oh my God, did we miss a week over here? The fact is, we now have hatched out 50 episodes. And for those of you that heard them all, thank you so much. Probably my mom is probably one that might have done that, maybe. A few others, perhaps. I'm not sure that if you go back in time and hear those first crackly, terrible sounding, echoey things, that you would think much of the production quality, but maybe the content was something that you could cause you to overlook all of the issues that we've had. To getting things better. And I expect as we go forward, it will just continue to get better and better. And isn't that what it's all about in podcasting? It's just, constantly getting a little bit better and making it more insightful and helpful to the listeners to bring, my real estate knowledge and my insight to share and to give back and help others has always been the goal. And we look forward to the next 50. Today, I've got a couple of things that are on my mind that are important in ways that you may not realize. So one of the things going on right now is private mortgage insurance has increased by more than 50% if you look at the homes purchased in 2020 and continuing through this year. What does that mean? Well, it means that when people are purchasing homes, they're putting less than 20% down. And that's historically been okay because there's conventional loans and FHA loans and VA loans that allow that to happen. The insurance is not for the buyer of the house. That's homeowners insurance. They purchase that. But for the bank, they purchase an insurance policy that's paid for by the homeowner. So in essence, the bank is saying if you default, we want insurance to cover our interest in the property. And the buyer makes the monthly PMI payment. And that number went up a lot, 53% in 2020. So what that's saying is a lot of first-time home buyers were able to purchase in a rising market, but they couldn't make the whole 20% down payment on that purchase. But their credit scores were high enough, their debt to income ratios were satisfactory that allowed them to make the home purchase. The number comes at around 55% of PMI users were first-time home buyers. So if you can think of a rising market and a pandemic where people absolutely wanted to move, there was no real differentiation between number of homes sold. Matter of fact, it was probably more. But a couple of good numbers that we're seeing right now is that more than 50, about 55% of PMI users were first-time buyers. Their average credit score for PMI buyers, 746. So these are people with really good credit, a really good risk to a lender. With a credit score that high, they're probably going to continue to make their mortgage payments. And in most cases, they're putting at least 3.5% down if it was FHA, 5% down minimum if it's conventional in that area. So they are putting some money down. And with the median home price, in the $300,000 neighborhood, they're putting $15,000, $20,000 down. So it's not as if they're going in with no money down. This was not built, this market, on the pretend loans, the liar loans from the early 2000s that decimated the industry and caused the banks to implode. These are creditworthy buyers with high credit scores, with a down payment that are able to make the payments and the PMI, which again is the insurance for the bank in case they default on the loan. So as people ask us, do we think we're in a bubble? Do we see a whole slew of foreclosures coming? Where's that next piece of inventory coming from? My leading indicators would suggest if somebody has a high credit score, they're likely to continue to make payments. And they got a mortgage that was full documentation within the tolerance of the debt to income ratio being satisfactory to get the loan. And there's mortgage insurance attached within there that they're making the payments on. These are probably not homes that are going to get foreclosed on. These are not the type of homes that people are going to stop paying for. When we look at the proliferation of cash that was used in the last year as well, it seems to me that if there are this many people with private mortgage insurance and approved loans and high credit scores, they'll keep paying. And if they paid cash, well, they just have to pay their taxes. And the rest, put 20% down. They have huge equity. So even if they have a mortgage, they're probably, again, not likely to default. If they had a $300,000 property, put 60 grand down. That's a lot to walk away from. It leaves a really small subset, if I'm sure, I would guess less than 10% of the population has, mortgages that might be at a little bit of risk. And that would be somebody that maybe made a purchase where they have to relocate, the next year. And maybe they don't have enough equity to make the sale in a home. That's a sort of let's make an assumption the buyer put, 3.5% down FHA. And the property went up a little bit in value, but by the time they pay commissions, closing costs, and fees, maybe it's a really skinny deal or they have to write a check to go back to closing. And if that happened, maybe it can get worked out. The difference in this market compared to others is that the mortgage insurance is going to people with high credit scores. I mean, the numbers are out there. And the default rates are super low right now. And even if we have mortgage forbearances that might hit the market, my suspicion is this. There are a lot of people that didn't make their mortgage payments through the forbearance program in 2020. There's a lot of them. But property values have risen so sharply that those buyers are likely to be able to sell the home for enough money to pay off the mortgage balance, any past due forbearance dollars, commissions, and closing costs. There's enough equity for them to actually not pay for the last year and walk away with some money. Now, they're going to have to take up a residence, most likely in a rental. It's going to be very hard for them to get another loan, but it's not likely to be a foreclosure. It's likely to be an equity sale where there's money returned to the property owner at the sale. And that's the difference of this market. is because the property values are high enough and the inventory is low enough to sustain this. My suspicion is you're going to see very few, if any, properties hit in the foreclosure area. And it would be for different reasons. I don't think it's pandemic reasons. I don't believe it's forbearance reasons. I believe that foreclosures occur somewhere between 0 and 5% just naturally. People stop paying. Not everybody continues to have good credit, and there's family situations and medical situations that cause these things to happen. So there's not that much out of the norm. So private mortgage insurance is probably a bigger deal and something you wouldn't think about often, and yet here it is. And it is an impact. Now, the other thing that I think is interesting is that there's a bill right now in Florida for the governor to review and perhaps sign that would limit the way local governments can dictate the impact fees. These are the things that pay for infrastructure. So, for instance, if you have raw land and there's no improvements to the land, there's no water, there's no sewer, there's no electric there, these are fees that impact the area around it. If they're putting in a new development of homes, well, then we might need roads or police or fire or other things that are considered infrastructure. What they're looking at right now in the current bill, and it's HB 337, so you can look that up and click on it. And the governor has until the middle of the month to review this and act on it. And what they're looking to do is limit the increase on impact fees to no more than 50% and doing it approximately every 4 years. If there is an increase that's on the higher side, 25 or higher, they would have to spread it out over a few years' time. Now, you can go deeper in the language, but the cursory review is this. They're trying to limit the change of impact fees to only once every 4 years. And if it's a really big one, 25% or more, they're going to spread it over, a few years or maybe the whole 4 years. This would be an assist to developers and to people purchasing properties to have more cost certainty on what the final outcome of the project is going to look like and cost and how it affects and impacts the other areas, the other homes that surround this area with the government. So they're trying to give public services to protect those fees, to have some certainty within the cost control structure so they can develop these projects and get them completed. It's no secret there's a lot of new construction going on right now, and it's impacting things and roadways and things that we haven't seen, 10 or 15 years. And it goes so much deeper than just, well, we got to get electric on the land or get the water, the sewer. It's all the other things that we've talked about. It's police and fire and schools and roads and who's going to stripe the land and who's going to put the traffic signals up. There's, it's a really long list of things that when homes are built, it ripples to so many other areas. So when they look to control those fees to an extent and spread them out over time, it appears to be a good thing. Now we'll see how the governor feels about this, and we'll see if it actually passes. But it was a really big margin, and I saw the number in the House in Florida, 94 to 23 was the approval, and 28 to 12 in the Senate, and this is in Florida. So it does appear there's a lot of sentiment that this is a good thing for the people of Florida, and we'll see. I know this is going on in other areas of the country, but with the dramatic increase in the construction in Florida, this is really something that I believe the rest of the country is paying attention to, and I believe that others may model after this once we have its completed form. It's pretty interesting stuff. So I've talked to you a little bit. So 2 things we have not talked about in the first 50 episode, impact fees for one and PMI. But I want to make sure that you understand how the news that is out there that may seem not important or wouldn't affect you actually can affect you. Hope you're enjoying the podcast today. I'm really excited to put this one in the books. We are 50 episodes in, and I could not be more thrilled to still be being here doing this with you. This is Ron Wojciechowski for the Black Hole of Real Estate.